Financial success versus financial ruin in real estate investing.
Right, so we definitely want you to be on the asset qualities and definitely not in that horrible financial ruin situation. We help our clients all the time with this, but really understanding when I get a call and say, I want to buy rental properties, and they say, okay, cool, what's the ROI that you're looking for? And then crickets, this person doesn't know what they're talking about yet. So I want to make sure we're talking about, we can explain it better. What is ROI? What are cash flow? What are the tax benefits? So we're going to kind of deep dive into these concepts so you're always making a profitable decision and you're staying an informed person. You want to add anything?
Exactly. And you need to know how these factors really benefits you, because it's all about numbers and how exactly it's going to help you. And that's why we're going to dive to the first thing, which is understanding the ROI, or return on investment in real estate.
Now, ROI, in simple words, is a measure to use to evaluate efficiency on the investment. In general, it's how much money your rental income is generating relative to the cost. So we're going to look at the math of this one now so you can understand a little bit more.
Therefore, if you want a simple math formula, really the ROI is the ratio of gaining from your investment minus the cost of investment divided by the cost of investment.
Now, remember, this gain will include net income the property will generate as well as equity over time. And costs are going to include the purchase price and any renovation. So we're just going to use an example, and then we're going to talk about this example as well.
Exactly. Therefore, let's assume that you purchase a $200,000 rental property and you spend additional $50,000 to renovate and bring it up to the code. And now your total investment is $250,000.
Right. In the first, now let's just hypothetically, in that first year, you made $24,000, which is you rented it for $2,000 a month after your expenses. So you're negative. You're going to be negative in this one because your first year is going to be what? How do you do that math?
Therefore, the gain from your investment was $24,000.
Well, that's how much you rented in rent.
Minus $250 because you put $200 plus $50 to renovate it, divided by $250, how much it costed you. And it brings us to minus 90.4%.
You might say, nope, definitely don't want the deal. But remember, this ROI is going to improve over time. You made improvements to this property, and it will eventually also have a general, as long as they're keeping it up, the rental property will also build up equity, build up higher rents as well, so that how much you make will go up on this property if it's the right one for you.
Exactly. But the next thing that is
Before we do the next one, let's do our introduction. Let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now tell me about cash flow.
Now, the next one is the cash flow. Cash flow is amount of the cash that being transferred in and out for your business.
So you want to make sure that it's being referred to your financial gain or your financial loss after all things are paid. This is honestly the simple one. Most people will say, what's the cash flow, and make all decisions based on this and not ROI. So I would definitely recommend really deep diving in ROI, but cash flow is simple, which is what?
Which is really, if you wanted to look at the monthly cash flow, is something like gross income, rental income, minus your operating expenses, which is anything that you spend on the property, and minus your mortgage payment is basically gonna give you the cash flow.
Right, so the last one we gave you a negative one. So now we're gonna give you an amazing cash flow example, right? Just to give you a thought on what you should definitely take that deal. If you can get a rental income property for $2,500 rental income a month, and then you can minus $500 for operating expenses, and that mortgage is only $1,200, take the deal, because that's $800 a month in cash flow that is positive to you. That's an easy one that we all want that deal, right? That's an amazing
Exactly.
deal.
Therefore, $2,500 minus $500 operating minus $1,200 your mortgage brings us to $800 positive cash flow. Now, We're going to talk about not only these important factors, but also the tax benefit. What are the tax benefits?
So taxes are something people don't understand enough about real estate investment. You can deduct interest, your mortgage interest, your depreciation, repairs, and property taxes on this home. So let's talk about it. Number one is interest, mortgage loans. Mortgages on rental properties can generally be deducted from your taxable income, which is number thing. What's the second one? What's depreciation?
The next
This
one
is an amazing one.
actually is depreciation. For basically residential, depreciation is the scale of 27 and a half years. Means each year, based on that scale, you have depreciation. You can claim that depreciation.
But what is it?
You explain it to them.
Is the process of deducting and buying and
Exactly.
improving that rental property. So instead of taking that one large deduction, you can deduct it the many years
And
that
the
my
many
husband
years.
was so excited to tell you about, which is exciting. He loves it. Number one is repairs and maintenance. This is the most
Repairs,
common.
the cost of the repairs and maintenance, definitely when we said that you renovate the house, like you put a new flooring, new AC, new roof, anything that basically you renovate that is necessary, and you can actually have deduction in your taxes.
It has to be reasonable though. So if you have unreasonable repairs and maintenance, this is going to be a red flag to the IRS. You want to make sure that we're sticking into the normal prices. The next one is going to be your tax benefit calculation. So let's just hypothetically say you have a $12,000 mortgage interest, you have $10,000 in depreciation that you're claiming, and then $2,000 for repairs. That is $24,000 that you are taking off your taxable income. So this is something to really understand. A lot of people don't like to pay taxes or pay minimum taxes, and a lot of people will look into the rental markets for this key.
Exactly.
We are not, by the way, we are not tax people at all. We are not saying we are not experts there. I'm just telling you what we hear from many people.
Therefore, by basically telling you all these factors that help you to manage profitability and help you with your investment portfolio, that you can make a knowledgeable decision.
Because we want you to be successful in real estate investment and make the right houses that you want, because this is the job you want. So with that, we can't wait to talk to you in our next video. Please click here if you want to see it. Otherwise, we are so excited that you're here. Please go to
Alan Victoria, call via real estate agent in local market, Greenville, Winterville, and if you wanted to invest, we'd love to help you.